Most undervalued stocks of 2023. The stock market had a difficult year last year, but defensive stocks fared better in 2023 because they remained stable throughout the terrible market. Before we begin, don't forget to hit the like button, subscribe to our channel, and ring the bell symbol for more wonderful videos. The good news is that there are still several affordable defensive stocks that are worthwhile of consideration for long-term investors wishing to invest in them. Many high-quality, defensive names like Viva Systems VIV and Medtronic MDT have space for development, according to Morningstar Equities analysts. Number 5. 3M. We think 3M stock is undervalued at the current price of roughly $144 per share, following an almost 20% decline year-to-date. From around $180 in early January, 3M shares dropped to $144 today. 3M has moved minus 20% this year, while the larger S&P 500 index has returned minus 11%. Over the longer run, the 3M stock is down 24% from its late 2018 highs. With Honeywell stock rising 44%, Corning stock rising 22%, and the S&P 500 index rising 70% during the same time period, this represents a major underperformance in comparison to its competitors and the larger markets. Number 4. Google. How resilient is Google stock to a business slump compared to other technology businesses amid mounting concerns about a U.S. recession? That is a crucial query for investors interested in Google stock. Alphabet's Google technical ratings have declined. Additionally, citing dimming economic prospects, advertising companies cut their 2023 digital media industry predictions in December. After Alphabet reported profit and revenue for the September quarter that were lower than expected due to its main digital advertising business, Google stock plummeted. In light of a potential economic downturn, Google plans to reduce hiring. Additionally, it intends to terminate its Stadia gaming platform in January. In 2019, it introduced the Stadia streaming service. In 2021, Google shares increased by 65%. However, Google's stock price fell 39% in 2022. The S&P 500 fell by over 19%. Number 3. Stanley Black & Decker. The short list of dividend kings would be an excellent place to start when seeking to find businesses that would be intriguing for dividend investors or investors looking to establish a passive income. This list of businesses includes Stanley Black & Decker, Incorporated. Additionally, the stock has been falling since the spring of 2021 and has lost nearly 60% of its prior worth over the past few quarters, making the company appealing for more reasons than just the fact that it is the king of the dividend. The top-line results appeared to be reliable. In comparison to $3,798.8 million in revenue during the same quarter previous year, Stanley Black & Decker's top line climbed by 15.6% to $4,393 million. Investors were undoubtedly more surprised by the full-year guidance than by the quarterly performance. Number 2. Walt Disney. My price multiple model, which compares Walt Disney's price-to-earnings ratio to the industry average, suggests that the company is costly. Because there isn't enough information available to anticipate its cash flows, I've used the price-to-earnings ratio in this case. The company is now trading at a higher price compared to its competitors because its current ratio of 48.07x is significantly higher than the industry average of 25.05x. This could suggest that the price can drop lower, allowing us another chance to buy in the future. This is because Walt Disney's share is fairly volatile. Its price swings are amplified relative to the rest of the market. Based on its high beta, which is a reliable predictor of share price volatility, this conclusion is drawn. Number 1. Apple. The trailing 12-month price-to-earnings ratio for Apple is 21.3, exceeding the 15-year average. At its present trading price, Apple is not a good value because investors are paying more than the business is actually worth in terms of earnings. The trailing 12-month earnings per share of 6.11 for Apple do not support the market price at which it is now trading. Despite good growth, Apple's valuation metrics are poor at the current price because of an overpriced price-earnings to growth ratio. A below-average valuation score is the result of Apple's PE and PEG ratio being poorer than the market average. That's it for today, guys. What did you think of the video? Please share with us in the comments section below. Also, don't forget to hit the like button, subscribe to our channel, and ring the bell icon for more incredible videos.